Hi, this is Michelle Davis, mortgage loan originator extraordinaire, and today I'd like to go through a loan estimate with you. With our digital world we've got going on now, everything that we sign tends to be electronic, and for as part of your mortgage application, you're going to be sent a disclosure package. Part of that disclosure package is a loan estimate. A loan estimate is all of the terms of your loan, your closing costs, what you can expect your payment to be. It's something that you should really go through with your lender. They should have no problem if you give them a call and say, hey, I'd like you to go through this with me, but I also would like you to know going in kind of what you should be looking for. So let's go through a loan estimate. First off, your loan term. The term of a loan is simply the length of the loan. Most of them are 30 years. There's also 20, 15, 10, and you can have some options in between. But by and large, you're getting a 30-year mortgage. The purpose of your loan, is it a purchase? Is it a refinance? Is it a home equity line of credit? That needs to be noted on the loan estimate as well. If your product is a fixed rate mortgage or an adjustable rate mortgage. We don't see very many adjustable rates right now. The interest rates we have today are still, to be honest, historically low. We would love for them to be back at 3% again, don't get me wrong, but I don't think we want the economic conditions that brought about those lower rates. So 6-7%, those are still pretty good rates. So the adjustable rates in today's market aren't very prevalent. Once they start to get higher, the interest rates, the 30-year fixed rates, if they, reach 10, 11, 12, whatever again, we would see adjustable rates. But right now, the adjustable rates and the fixed rates are pretty close, so there's no benefit to that. For our purposes, we're going to look at a conventional mortgage. You can go conventional, FHA, VA, or USDA. I'll go through those different loan types in a different video. But for our purposes today, we're going to look at a conventional mortgage. Is the rate currently locked? Usually at loan estimate time, your interest rate is not locked in yet. Locking will occur within 30 days of closing. That's when you get the best pricing. A lot of times your loan estimate, you might not even have a property identified yet. So you're saying, I want to be in this neighborhood and I'm looking at this price. What am I looking at for payment, closing costs, all that? So this is kind of a preliminary look at the financing of your home. And again, for our purposes, we'll look at a sale price or purchase price of $420,000 with a 5% down conventional mortgage. Just below that information, we start to talk about the loan amount. So a 95% of 420,000 is a mortgage amount of $399,000. The interest rate you're quoted is usually what's called the par rate. So the par rate means that's the rate that's free. You're not buying down to get a better rate. So the interest rate will be noted here, and your monthly principal and interest payment. So this is strictly based on the loan amount and the interest rate. We're not talking about any escrows involved there. And then these three items will never change through the life of your loan. Your payment might go up and down based on your escrows, but these three things, the original loan amount, interest rate, and your monthly principal and interest, or your P&I, will remain the same. And even if your loan is sold to another servicer, say you write your check today to lender A, and then they bundle it up and they sell it to another company that's going to service it, you're now writing your monthly payment to mortgage company Z. These things remain the same. These can't change. Is there a prepayment penalty or a balloon payment? These should both be no. Our bank does offer a 5-year balloon product, but I can talk about that in another video, but both of these should also be no. There should be no, I haven't seen a prepayment penalty for a very long time. Your projected monthly payment. So because this is only 5% down on a conventional loan, there is mortgage insurance that gets paid until you reach 20% equity. They've kind of calculated out that it's about 12 years before you reach that threshold and your mortgage insurance will drop off. So they show you your projected monthly payment for the first 12 years, and then after the mortgage insurance has dropped off, what your payment would be going forward. Are you escrowing for your property taxes and insurance? So this is an option to you. If you choose to escrow, then when your annual homeowner's insurance premium comes due, you will have saved every month, and the mortgage company makes that payment for you. And your property taxes, they get a copy of your property tax statement also. So they will adjust your mortgage amount based on your updated property tax information. So there's no penalty to escrow, and there's no penalty to not escrow. Some of the loans may require you to escrow until you have a certain amount of equity, but by and large, you should be able to choose if you want to escrow. Most people do, just because it's easy, just because you're not hit twice a year with your property tax bill. So these are estimates at this point. If you've already identified a property, we'll use those actual property taxes as part of this estimate, but you probably don't have your homeowner's insurance premium yet. So we'll estimate what an average monthly homeowner's insurance payment would be, and that's how we come up with your estimated taxes and insurance. Your estimated closing costs. So these will be identified on the next page, but your closing costs include your loan costs and your prepaids, your impounds, your escrows. That'll be really dug into on the next page. And your estimated cash to close. This is the amount of the check you'll need to bring to closing in order to make the home yours. Page 2 of the loan estimate, the origination charges. So this is what the bank makes. There would be underwriting fee, you'd see here, processing fee. If you're buying down your interest rate, the points you're paying, they call them points for your buying down your interest rate, will show up here. It's possible you even get a credit. You can choose to have a little higher interest rate if you'd like a credit towards your closing costs also. Section B, services you cannot shop for. These are things that we are required to gather for your loan. We typically need an appraisal. Unless you're doing a higher down payment, we're going to have to order an appraisal to make sure that the home has the value that supports what we're lending it on, or what we're lending you the money for, however you want to say that. Credit report fee, flood certification, these are all items that get passed along to you. Services you can shop for, these are title fees. If you have chosen your title company based on the recommendation of your lender or your realtor, these will be listed here. For the loan estimate purposes, we just kind of grab averages for title exam fee and settlement fee. They're going to vary a little bit. There's a lender's coverage premium that protects the lender should you close the property and then somebody after the fact says, hey, I put a new roof on this home and I didn't get paid for it. So then they slap a lien on the property. They take care of that. So this is to protect them from any claims on the title. Those are your total loan costs at the bottom there. Other costs. So there are taxes and government fees. So we pay the government to record your deed and your mortgage. And then there's a transfer tax that in our area is 0.23% of the loan amount. Prepaids. So you're required to have a full year of homeowner's insurance. Say that fast twice. Homeowner's insurance paid up front. You can pay that outside of closing. Most people pay that at closing. And at this point, this is just going to be an estimate based on what we estimated as the monthly fee for the annual fee. And then prepaid interest. If you close in the middle of the month, so you close June 15th, you pay interest on your loan from June 15th through the 30th. You'd live in your home in July, and your first payment is due August 1st. So this just depends on what day of the month you are closing and your loan amount, things like that. Initial escrow payments. So in order to, if you want to escrow your property taxes and insurance, the lender will set up an escrow account at time of closing. So in that escrow account, they will calculate when these payments are going to be due and how much should be in the account so that when those bills come due, there's not a deficit in the account. So these will change a little bit. I usually estimate 3 months for each of those, and that's going to vary a little bit, but that's what that is if you are escrowing property taxes and insurance. If you have a realtor and they are charging a broker admin fee, this will show up in other. And then the owner's coverage title premium shows up here also. So this is a one-time fee for an insurance policy that protects you from any claims on the property. So the lender's policy protects the lender, the owner's policy protects you. So if you're buying a home that was remodeled and you want to make sure you're protected from anybody who might have done work there who didn't get paid, you want to buy the owner's coverage. Most people do. It's a one-time fee. It's just kind of peace of mind. Here you were calculating your cash to close. This is where your earnest money, on here it's called the deposit, your earnest money will show up here. That will be deducted from your cash to close. If the seller's paying any closing costs, that's going to be shown there. A lot of times there's a little adjustment or a credit from the lender. Maybe they've calculated to get too much money initially in your escrow account, then they'll give you a credit and adjustment for that. Last page talks about the whole, kind of the big overview of your loan. In your first 5 years, how much equity will you have bought down essentially? What's your annual percentage rate, your APR? This isn't your interest rate. This is the APR is calculated with all of your closing costs and your loan amount, what that initial interest rate is. It's just for calculation purposes. And then other considerations. Appraisal. We will do an appraisal on your property because we want to verify the value. We don't want you purchasing a home for $500,000 when it's really only worth $400,000. Then you'll be what's called upside down. You'll owe more on the property than it's worth. So if you go to sell it, you'd have to actually bring money to closing, which is not, nobody wants to be in that position. Is your loan assumable? Most loans these days are not assumable. A VA loan is assumable, but it's not as great as it seems. So an assumable mortgage, say you've got a 2% mortgage, you bought your home for $300,000, it's now worth $500,000. The loan is assumable, but the balance on that is $200,000. If you're selling your home for $500,000, somebody has to come up with that difference, and very few people can. So an assumable mortgage these days isn't really a thing. This just states that you must keep homeowners insurance on the property at all times while there's a loan on it. If it were to burn down and you didn't have homeowners insurance, you're still responsible for the mortgage payments. If you have insurance, that would possibly, pay that loan off, or however you decide to do that. Late payments, you have a 15-day grace period on your mortgage. After that, a lender will charge 1% as a late fee. This is noted on here. Refinance, it just states that all loans are refinanceable, but you may not qualify to refinance because you still have to qualify financially. If you've lost your job, you'd like to refinance, chances are you can't because you don't have the income to support. So this is just saying that you can refinance, but based on the conditions, your financial state at that time, you may or may not be able to refinance. And then servicing. Servicing is simply who you write your check to. Like I said earlier, a lot of mortgages are sold from lender A to lender Z. Nothing changes with your mortgage except who you write your loan, write your check to. So it's not a big deal. It's just a fact in the mortgage world. So if you made it this far, thank you. Mortgage loan originator extraordinaire Michelle Davis. You can check below. I lost my W there in my face. For my contact information, I would love to help you get qualified for a mortgage. Or if you have any mortgage questions, I'm happy to answer them all. Happy house hunting and have a fabulous day.